Meet Olivia and Sophia. Both are 31 years old. Both earn about $78,000 a year. Both live in the same city, pay similar taxes, and share the exact same goal: build enough wealth to enjoy a comfortable retirement someday. At first glance, their financial journeys look almost identical. But one decision will quietly create a difference worth hundreds of thousands of dollars over the next 3 decades. And neither of them realizes it at the beginning. Olivia loves investing. She follows financial news every morning, listens to earnings calls, reads analyst reports, and spends hours researching companies she believes will dominate the future. When she opens her brokerage account, she carefully spreads $1,100 each month across a collection of stocks. Some are giant household names everyone recognizes. Companies like Apple, Microsoft, Nvidia, and Alphabet. Others are fast-growing businesses she believes have enormous potential. A few are smaller opportunities she thinks Wall Street is still overlooking. Every purchase feels intentional. Every position has a reason behind it. Every stock tells a story. Sophia takes a completely different approach. She opens the same type of brokerage account and invests the exact same amount every month. But instead of researching companies, she buys a single S&P 500 index fund. That's it. No stock selection. No earnings reports. No debates about which company will dominate artificial intelligence. No late-night research sessions. She simply buys the entire market and moves on with her life. To Olivia, this approach feels almost too simple. How could doing less possibly compete with doing more? After all, investing should require skill, shouldn't it? The more effort you put in, the better the results should be. At least that's what most people naturally assume. And for the first few years, it seems like Olivia's assumption is absolutely correct. One of her technology stocks surges. Another doubles. A third climbs far beyond what she originally expected. Whenever friends ask about investing, Olivia has exciting updates to share. She can point to specific winners. She can explain why she bought them. She can talk about trends, products, earnings, and future growth. People enjoy listening. Her portfolio feels active, interesting, intelligent. It looks like she's playing the game exceptionally well. Sophia, meanwhile, has almost nothing interesting to say. Her index fund went up. Then it went up again. And then it continued doing exactly what index funds usually do. There are no exciting stories. No hidden gems. No bold predictions. No impressive research process. Just a steadily increasing number on a screen. It's boring. Painfully boring. And because it's boring, many people assume it can't possibly be the superior strategy. But investing doesn't reward excitement. It rewards results. And over the next 30 years, the difference between what Olivia believes is happening and what is actually happening will become impossible to ignore. The most surprising part? The gap isn't created by one huge mistake. It's created by several small costs that most investors never notice. Tiny leaks. Small enough to seem irrelevant, yet powerful enough to quietly reshape an entire financial future. At the beginning, though, none of that is visible. All Olivia sees are winning stocks. One position climbs nearly 85%. Another gains over 45%. Several outperform the broader market. Every successful pick strengthens her confidence. Every gain feels like proof that her research is paying off. When she talks about investing with coworkers or friends, these are the stories she shares. The big winners. The exciting gains. The successful predictions. And honestly, why wouldn't she? Those are the positions worth talking about. But there are other positions too. The company she sold after a disappointing decline. The stock she stopped buying after it dropped more than 35%. The investment that's been sitting in her account for nearly 2 years waiting to recover. Those stories rarely come up. Not because she's hiding anything. Not because she's dishonest. Simply because human beings naturally remember successes more clearly than failures. Everyone does it. Sophia doesn't experience any of this. She doesn't have favorite stocks. She doesn't have disappointing stocks. She doesn't have investment stories. She owns the entire market. When the market rises, her account rises. When the market falls, her account falls. There's nothing to analyze. Nothing to defend. Nothing to explain. Just a long-term process repeating month after month. Meanwhile, Olivia feels engaged, connected, involved. She follows earnings reports, reads breaking news, tracks company announcements, updates her investment thesis whenever new information appears. Investing has become a hobby as much as a financial strategy. She enjoys it. And that enjoyment makes her feel productive. It feels like all those extra hours must be creating an advantage. Because if someone spends several hours every week researching investments while another person spends almost no time at all, common sense suggests the researcher should eventually pull ahead. Right? That's the assumption millions of investors make. It's also the assumption that will eventually determine which of these two women retires with substantially more money. Because what looks intelligent on the surface and what actually creates wealth are not always the same thing. For now, Olivia feels like she's winning. Her portfolio is exciting. Her winners are impressive. Her confidence is growing. And from the outside, almost everyone looking at her account would agree. But appearances can be deceptive. Especially in investing. Because the real story isn't hiding inside the stocks Olivia remembers. It's hiding inside the ones she doesn't. And once we examine what actually happens across decades instead of months, the entire picture begins to change. The next piece of the puzzle starts with a simple question. What if the biggest challenge in stock picking isn't choosing good companies? What if it's understanding how stock markets actually create wealth in the first place? The problem becomes much bigger when we stop looking at individual stories and start looking at actual data. For years, Olivia believes her stock picking strategy is working. After all, she can point to winners. She can show impressive returns. She can name companies that outperformed. But investing success isn't measured by the stocks you remember. It's measured by the complete portfolio. And that's where things start to change. Every investor naturally talks about their winners. Very few talk about the stocks they sold at a loss. The positions they abandoned. The companies they believed in that never delivered. Over time, Olivia's memory becomes a highlight reel. Her brokerage statement tells a different story. Meanwhile, Sophia doesn't need to remember anything. She owns the entire market. No favorite stocks. No forgotten mistakes. No emotional attachment. Just market returns. And this is where one of the most important studies in stock market history enters the conversation. A finance professor analyzed nearly every publicly traded U.S. stock dating back to 1926. More than 25,000 companies. The question was simple. How many stocks actually beat short-term treasury bills over their lifetime? The answer shocked investors. Roughly 57% of stocks failed to outperform treasury bills. More than half of all stocks couldn't beat one of the safest investments available. But it gets even more surprising. The research found that only about 4% of companies created virtually all of the stock market's long-term wealth. Just 4%. That means a tiny group of extraordinary winners pulled the entire market higher while the vast majority delivered average or disappointing results. Think about what that means. The stock market's success doesn't come from thousands of amazing companies. It comes from a very small number of exceptional ones. Miss those winners, and your results can fall dramatically behind. Sophia never has to worry about this. By owning an index fund, she automatically owns every future Apple, Nvidia, Amazon, Microsoft, and Alphabet. She doesn't need to predict which company becomes the next superstar. The index captures them automatically. Olivia faces a much harder challenge. Even if she chooses excellent companies, she still needs to identify tomorrow's biggest winners before everyone else does. Then she needs to hold them for decades. Then she needs to avoid selling too early. That's an incredibly difficult task. And the data shows it isn't just difficult for individual investors. It's difficult for professionals too. Every year, researchers compare actively managed funds against simple market indexes. These aren't casual investors. These are full-time professionals with research teams, advanced tools, market data, and decades of experience. Yet year after year, most fail to beat the index over long periods. Over 10 years, the majority fall behind. Over 15 years, the numbers become even worse. Over 20 years, underperformance becomes the norm rather than the exception. If highly trained professionals struggle to consistently beat the market, the odds become even tougher for individual investors researching stocks during evenings and weekends. And that's before considering the hidden costs. Every time Olivia sells a position, takes profits, or switches into a new idea, taxes can be triggered. Every trade creates friction. Every decision creates opportunities for mistakes. Sophia's index fund keeps moving forward with very little intervention. Low turnover. Low maintenance. Low friction. Olivia's strategy feels more active, more intelligent, more exciting. But investing isn't a competition to look busy. It's a competition to maximize long-term wealth. And the data keeps pointing in the same direction. The more concentrated the portfolio, the harder it becomes to consistently capture the tiny group of companies responsible for most market returns. That's the hidden challenge stock pickers face. Not finding good companies. Finding the few extraordinary companies that end up carrying the entire market. And history shows that's much harder than most investors realize. Of course, index funds aren't perfect. Sophia owns every company in the index. That includes the future winners. But it also includes plenty of average businesses and some outright disappointments. She's buying everything. The good and the bad. There's also another reality. A handful of giant companies often dominate the index. When major tech stocks struggle, the entire fund feels the impact. And unlike Olivia, Sophia can never dramatically outperform the market. She owns the market. Her goal isn't to beat it. Her goal is to capture it. Those are real limitations. But compare them to the challenges Olivia faces. Taxes. Research time. Trading mistakes. Concentration risk. The possibility of missing future market leaders. The list is much longer. And over time, those small disadvantages start adding up. At first, the difference is barely noticeable. After about a decade of investing, Olivia's portfolio looks healthy. Sophia's does too. Both accounts have grown substantially. Neither investor feels worried. But beneath the surface, a gap is forming. A few extra taxes here. A few poor decisions there. A few missed opportunities. Nothing dramatic. Nothing obvious. Just small leaks quietly compounding year after year. By year 15, the difference becomes harder to ignore. Sophia has accumulated tens of thousands more. Not because she made brilliant predictions. Not because she discovered secret investments. Because she consistently captured market returns while avoiding many of the costs that slowly reduced Olivia's performance. Then comes year 20. Now the gap is no longer small. It's substantial. And the strange part is that Olivia still feels successful. Her account keeps growing. She still has winning stocks. She still remembers great investment decisions. The problem is that she's comparing herself to her past self, not to what she could have earned. That's where many investors get trapped. Underperforming the market doesn't feel like losing. It feels like winning more slowly. And when that happens for 20 straight years, the cost becomes enormous. Every year, a little performance disappears. Every year, a little more money fails to compound. Every year, the gap widens. Not through one major mistake, through hundreds of tiny ones. A stock sold too early. A losing position held too long. Taxes paid along the way. Cash sitting on the sidelines while waiting for the perfect opportunity. Small decisions. Massive consequences. By retirement, both women have invested consistently for 3 decades. Both worked hard. Both saved diligently. Both stayed committed. Yet the results look very different. Sophia's portfolio has grown to roughly $1.9 million. Olivia's portfolio sits closer to $1.3 million. The difference is around $600,000. Not because Olivia was reckless. Not because she was unintelligent. In fact, she spent far more time thinking about investing than Sophia ever did. The difference came from structure. Sophia owned the entire market. Olivia tried to choose the winners. And history shows that identifying the biggest winners ahead of time is far harder than most people believe. The gap becomes even larger when taxes are considered. Over decades of buying and selling, Olivia continuously created taxable events. Sophia rarely did. Thousands upon thousands of dollars that could have remained invested instead disappeared into tax payments. Then there's inheritance. If Sophia passes her investments to her children, many of those accumulated gains can receive favorable tax treatment through a stepped-up cost basis. Much of the tax burden effectively disappears. Olivia doesn't get back decades of taxes already paid during active trading. That money is gone forever. And that's the lesson most investors never hear. Olivia didn't fail because she chose terrible companies. She fell behind because stock markets reward broad ownership more often than concentrated prediction. The market doesn't require investors to be brilliant. It rewards investors who consistently own the companies that eventually become brilliant. Sophia captured them automatically. Olivia had to find them in advance. One approach depended on being right. The other depended on simply staying invested. And over long periods of time, that difference changes everything. At this point, every stock picker raises the same objection. Sure, but what if Olivia had simply bought Nvidia early? Fair question. Because if Olivia had invested in Nvidia years before it became a trillion-dollar giant and held every share through the ups and downs, she'd likely retire far wealthier than Sophia. The same is true for Apple. The same is true for Amazon. The same is true for several legendary stocks that created life-changing wealth. So doesn't that prove stock picking works? Not exactly. Because those stories all share one thing in common. They're viewed through hindsight. Today, everyone knows Nvidia became a winner. Everyone knows Amazon dominated e-commerce. Everyone knows Apple transformed consumer technology. The hard part wasn't identifying those companies after they won. The hard part was identifying them before they won. History is filled with companies that looked unstoppable and never delivered. At the peak of the dot-com boom, one technology company was considered nearly unbeatable. Analysts loved it. Investors loved it. Wall Street couldn't stop talking about it. That company was Cisco. For a brief period, Cisco became one of the most valuable companies on Earth. Many investors believed it would dominate the future. Instead, investors who bought near its peak spent decades waiting just to recover their money. That's the problem. Future winners look obvious only after they've already won. For every Nvidia, there are countless companies that looked just as promising but failed to deliver. And nobody tells those stories. Because nobody celebrates the stock they believed in that went nowhere. Sophia never had to predict the winner. She automatically owned every future champion the moment it entered the index. She owned the successes. She survived the failures. She didn't need to be smarter than everyone else. She simply needed to stay invested. Now, does this mean buying individual stocks is always a mistake? No. There are situations where it makes perfect sense. If you're investing inside tax-advantaged accounts, many of the tax disadvantages disappear. If you genuinely possess deep expertise in a specific industry, you may have an informational advantage others don't. And if you're allocating a small portion of your portfolio for learning, curiosity, or enjoyment, individual stocks can be a valuable experience. The key is understanding their role. Too many investors treat stock picking as their retirement strategy. A better approach is treating it as a side strategy. Let your core portfolio build wealth. Let your stock picks satisfy your curiosity. That's a very different mindset. Because once you understand the data, the goal changes. The goal isn't finding the next apple. The goal is making sure you don't miss the next apple. That's exactly what index investing accomplishes. It captures every future winner automatically. No predictions. No guesswork. No constant monitoring. Just ownership. And that's why the math consistently favors the index. Lower costs. Lower taxes. Less time. Fewer mistakes. More diversification. More consistency. The investing industry often makes wealth creation sound complicated because complicated solutions are easier to sell. Simple solutions rarely generate headlines. But simplicity and effectiveness are not the same thing. Over and over again, the evidence points in the same direction. For most investors. For most time periods. In most taxable accounts. Broad index funds win. Not because investors lack intelligence. Not because stock pickers are foolish. But because that's how markets are designed. A tiny number of extraordinary companies generate most of the wealth. The safest way to own those companies is to own all of them. Olivia spent decades trying to identify the winners. Sophia spent decades owning them. And in the end, that difference changed everything. So before you ask yourself which stock will become the next Nvidia, ask a more important question. Do you really need to predict the winner? When you can simply own them all.